Kia ora, I'm Chelsea Daniels, and this is The Front Page, a daily podcast presented by the New Zealand Herald. Labour has announced what some are describing as a watered-down version of a capital gains tax. Labour's targeted CGT would affect profit made after July 2027 from selling a commercial or residential property, excluding the family home. Leader Chris Hipkins promises 9 out of 10 Kiwis won't pay tax on what they own, and it'll allow everyone to get 3 free doctor's visits a year. On the flip side, Nationals calling it an attack on investment and savings, with Finance Minister Nicola Willis saying it would put New Zealand's economic recovery at risk. Today on the front page, Infometrics economist Brad Olsen is with us to dive into the details of Labour's latest pitch to the public. Brad, tell me what your first thoughts were when you saw this policy.
Look, it was challenging to see when we got the policy announcement. It came out very early in the morning, 5:03 a.m, I think, but it didn't have some of the fairly basic policies that you might have expected or basic elements of a policy on tax. It didn't have any numbers around it. We didn't know how much revenue this capital gains tax or limited capital gains tax was expected to bring in. So that was a bit challenging to start with. Alongside the fact that, looking through the detail, it was clear that this was a very narrow capital gains tax. It was focused on the likes of residential property outside the family home and commercial property, but it had a much longer list of exceptions that weren't included. And when you sort of have a policy that includes 2 bullet points of what is in and a whole lot of bullet points of what's cast out, you really do start to get the feeling that it's sort of quite constrained. The idea generally with a tax policy, certainly from an economics point of view, is you want it as broad-based as possible so it reduces those administration costs. It means that income is broadly sort of taxed a similar way instead of, at the moment, we now start to risk having a whole lot of different silos that things fall into. Probably one of the more challenging ones that we've started to uncover as we've started to get through the policy detail is the fact that this policy is expected to pay for a new healthcare policy for 3 GP trips per person per year. The difficulty is it looks like what we call a hypothecated tax, that the money that is coming in from the capital gains tax is ring-fenced and can only be spent on that new health proposal. So it does seem a little bit odd to tie capital gains to health funding. Good to sort of see a connection in terms of the government wants to highlight a priority area, but seems a little bit sort of specific to link those two parts together.
First, I have a couple of things to unpack there. First off, can you tell me a little bit more about the numbers? How much do they actually expect to generate from this ring-fenced policy? And secondly, is it even possible economically to make sure that specific money goes into this specific pot?
I mean, certainly you can make sure that it goes into that specific pot. We have very limited sort of direct funding initiatives in New Zealand, but one of them is the likes of the National Land Transport Fund. So all the money that goes from the likes of the petrol taxes and similar goes into a separate pot that can only be spent on transport. So we do that. It is an option, but it's unusual to link something like capital gains and health. If you were to link health money in to health money out, maybe, but to have something sort of quite different on the ins and the outside is unusual. You can technically do it, but to your first question around how much is expected to be brought in, it's not going to be nearly as much as anyone probably would have thought of for capital gains, just aren't nearly as strong forecasts into the future. And so, the figures are in sort of the low hundreds of millions of dollars that are being talked about. And Labor themselves highlight that the expected amount coming in is expected to be small and to sort of scale up over time. And I think that's understandable given where the likes of the property market and similar is. But we're not talking a lot. It's not billions of dollars a year that we're going to be generating from this sort of proposal going forward if it were to come into action.
Well, if we speak hypothetically as well, if it did come into action, I can see everybody selling off stuff before the tax takes effect. Does that usually happen?
Potentially, I think that'd be a little bit short-sighted from people. I mean, and realistically, that's because of one of the biggest misconceptions of like the capital gains tax is that, oh well, I've got all these gains that are going to be taxed for the last 50 years. No, the policy is quite clear that it's not retrospective. It starts from, I think, the 1st of July 2027, if it were to be enacted. So it means that you could buy a house right here today. It might make, let's say, $50,000 between now and 2027, and then after 2027, you make another $50,000, so 100K all up before you sold it in, I don't know, 2029. You'd only pay tax, and it would be 28% of the profit, so the additional gain that you'd make, which would be the $50,000 made after July 2027. So you might have had an asset for 40 years, doesn't matter how much of a capital gain it has made, none of that would be taxed. It's only sort of going into the future. So I'd find it pretty hard to believe that there'd be a whole bunch of people out there who'd have an asset at the moment and who'd go, you know what, I'm going to sell it off and then do what with the money? Presumably buy another asset in the future. So there's a lot of talk about it. I just don't think it would be necessarily as sensible to do it. Quite different, though, this proposal from the likes of a wealth tax, where no matter if you sold it or not, you were going to be paying a whole bunch of tax out each and every year, which is generally why capital gains tax is a much more appropriate way to move things in the tax system than to go for something like a wealth tax.
I only say that because a lot of people sold their houses and cars before the rapture was meant to be coming. So I know that there will be a few people selling off their farm or their commercial property beforehand. In terms of So that I know that they're allowing for, I think Aisha Verrill said 4.5 million extra doctors' visits, a couple of $100 million. Do you reckon that'll cover it?
Well, I mean, look, they've done some costing, so at least we've got some numbers now. So far, we're operating a little bit in the blind. Always nice to have a little bit more detail behind them, but look, we'll sort of work with what we've got for the minute. I think going forward, there's a question of, how does that sort of change demand for healthcare in general? But also, I mean, one of the questions and the challenges here is, why universal? Why do people who earn, I don't know, $200,000 a year, why do they need three free GP visits a year? Like that seems like an extreme amount of funding to sort of put universally for something like that, rather than targeting it to those who need it the most. And I mean, part of that seems to come down to an ideological sort of divide. We have some groups and parties and similar who go, well, everything should be universal. Others who think it should be quite sort of specific and targeted. Look, generally, personally, in economics, I generally lean into more of the let's get it to the specific people that need it camp, because that's where you then can reduce some of the costs, so you don't have to sort of put it out to everyone. But look, there will be a question, I think, around the likes of resourcing and similar in the health system, given it's already under pressure. But getting more money into frontline services, into that sort of proactive, preventative work that GPs do is important. If you can get more resource in there, then you shouldn't have to put as much resource into the other end of the spectrum, because people will actually go and get their issues sorted earlier rather than waiting, going to the hospital when it's too late and then costing a whole lot more. So I can see that part of the approach on balance as being quite efficient. It's just, can you resource it? And look, there's a challenge there at the moment, so I think there will be an ongoing challenge in the future.
Other countries have been doing this for years. Across the Tasman, Australia has had a capital gains tax for decades. It treats rising wages, better conditions and strong public services as signs of success, and New Zealand should do the same.
In terms of the exemptions for family homes, farms, KiwiSaver, business assets, that kind of thing, why do you think they've taken this approach?
Look, in my mind, the exemptions that they've made with this narrow capital gains tax is very much sort of politics over economics. There is an argument for a capital gains tax at a comprehensive level. And in my mind, as an economist, that would include the family home, just so that you don't have this sort of ability for everyone to sort of play games with it. And, you sort of say, well, my family home is the one I grew up in and my partner's family home is the one that they grew up in. So we get two, all that sort of question around inheritance and everything else, what happens to that sort of farm if you then sort of subdivide something off and you add an extra property onto it? Is that a second home, or is that just a farm still, which becomes exempt? Like, you just get into this really big challenge of sort of ruling in, ruling out that causes more administration. You need to get the accountants and the lawyers and all that involved. So I find that a bit challenging, but I think that's pragmatic from the Labor Party because they want to manage the politics of this. They've been hit before with worries around a more comprehensive capital gains tax or wealth tax or similar that would be quite broad. This time it's sort of focused very much into areas that I expect they think as a political party has a little bit more ability to influence the electorate. If you're sort of looking at taxing people who have a second home, that's not a particularly large group, or those who have commercial properties, it's not sort of, it shouldn't be inhibiting business activity itself and everything else. I think that's the argument. And that came through in the release from the Labor Party, focusing on the fact that I think 9 in 10 people wouldn't be hit by this narrow capital gains tax. So again, there's sort of a variety there in terms of what they're trying to focus on politically as well as economically.
And the fact of the matter is, Labor's spent years avoiding the issue of a wealth tax or a capital gains tax. Will they, won't they? What do you reckon shifted the dial with Hipkins?
Well, I mean, probably a little bit of the response to last time they tried this. I mean, remember that last time that Labor was in government, and I think this is probably one of the worst ways you could ever go about tax policy, to be clear, is telling everyone, telling the electorate, telling the people, no, it's not happening, we're not looking at it, it's not going to happen, designing a whole system behind everyone else's back and then dumping it sort of a month or so before the budget, which is exactly what we saw in, I think, 2023. We need to have a conversation about tax in New Zealand. I absolutely think that's true, but we need to have a good conversation rather than sort of a bit of a bait and switch where you tell everyone one thing, do the other, and then you just undermine everything. Because, well, at the moment, who sort of would trust what Labor says on tax? That's the challenge that I think they have, which is also why I think they've come out with this fairly narrow approach and going, well, look, this is not going to knock the socks off everyone. It's a sort of more quite constrained option. It's a constrained tax policy being taken, and it's a more sort of softly approach. The risk, of course, with that is that, well, does it do enough to sort of change the dial? And after a period where, let's be clear, capital gains have run their course a little bit, maybe not fully, but some of your bigger capital gains happened over the last sort of 10, 20 years, and with house prices currently down on a year ago, depending on the measure you use, it's still not looking particularly strong to have those in the future. What I think changed is political polling. You've seen continued support actually in the last couple of years for a capital gains tax, at least at this more sort of narrow level. So it does give an ability to say, well, look, people are asking for it. There's clearly a want as well to invest more into health. So I think that's where bringing everything together, there was an economic reason as well as a political reason.
Now, I watched Chris Hipkins stand up. There were 3 words he refuses to say: capital gains tax. Mark my words, that is what Labor is proposing. And far from what Hipkins and Edmonds have claimed, this is a broad capital gains tax. It will include all commercial property, that is to say, land and buildings that are not residential. That is effectively a tax on every business in New Zealand.
Is it disappointing that they haven't gone the full hog, though?
Oh, as an economist, I think it is a missed opportunity to have not have done the whole thing, or to be honest, have thought about what we could do or should do more broadly around the likes of the tax system, in terms of how you sort of support more economic activity, but also sort of the efficiency and the equity of the tax system. Like, the idea here, right, should be that you bring together as much money as you need to fund the government from as broad of a set of sources as you can, so that there's sort of no one area that doesn't get taxed, which means that another area has to get taxed a whole lot more to make up for it. And so in my mind, having something like a comprehensive capital gains tax does seem sensible. It might not make a lot of revenue at the moment, that's fine, but also looking at other options like a land value tax or similar, or importantly, trying to reduce the top tax rate, which at 39% really does diminish the ability for people to want to, or the ability to invest in businesses to quite the same degree, because when they get those returns, well, once they get over a certain amount, they you lose sort of, nearly 40%. All at once. So there is a challenge there, I think, around the sort of cohesiveness of the entire tax system. I think it is a missed opportunity to have done more, but at least we're having the tax debate. The concern, of course, is that this has already started to turn into, a real misinformation well. People talking about tax, I've seen some parties who are opposing this saying, this is coming for businesses. And it's like, no, it's not. It's coming for the profit on someone who's got a commercial holding. So they might have a $25 million factory or something that they've had for 30 years. if it makes an extra $30,000 over the next couple, they will pay 28% tax on the $30,000 more, not on the entire value of the asset. Like, there is some real stupid scaremongering out here that I think misses the issue. But at the same time, as an economist, yeah, I would have definitely liked a more comprehensive option, if not having thought even more broadly about the tax system.
Yeah, and certainly not small businesses as well, who I assume would be renting their premises or the shops or whatever they're working out from. Why do you reckon they stopped short at introducing a wealth tax? I mean, do you reckon that they had a look at the Greens and saw the backlash they got on all of their wealth tax stuff from that Green budget, and they just backed off and said no, like we're not dipping our toe into that?
I mean, potentially, I sort of expect as well that they will have done quite a bit of work in the background. And I know, you've talked to people that seem to have a little bit more inside knowledge, and they highlight that over time there have been discussions within the Labour Party over which way to sort of tack on this. But the evidence around the likes of wealth tax, I don't think it stacks up. I mean, you can see that in terms of how many countries, developed countries, actually have a wealth tax in comparison to something like a capital gains tax, and some of the advice that was coming through from Treasury when Labor last tried to look at this when they were in government. There was a much greater focus on, a capital gains tax or doing something more in that area. So I sort of think that it's a combination of, politics and economics, again, trying to find the best middle ground. But the question, right, is with how narrow a policy this is, both in terms of the money it brings in and what it pays for, is it enough to turn the dial? Because, you've seen a lot of calls from some political quarters saying that there needs to be a whole lot more investment in government. If there's not that ability to sort of raise a huge amount of revenue from the policy, are we spending a lot more time on a policy than it's actually going to sort of influence in our daily lives, potentially?
Yeah, and they could know that as well, the hesitancy, tacking it on to such a big issue like health. And I don't know whether you saw the press conference with Barbara Enbens, Chris Hipkins and Aisha Verrill, but a majority of it was talking about health. Right? They started off saying, look, they led with aspirations of a better healthcare system. They're saying Luxon's bringing the country backwards. There are Kiwis leaving the country. And this is all before they mentioned the word tax, mind you. So that kind of seems to me like they were hesitant with this. So they've tacked it onto something that Kiwis care about.
Yeah, definitely. Look, I think the challenge going forward for all political parties is how you sort of square the current finances that the government has, where we are still expected to spend more as a government than it will earn all the way out to something like 2030. But at the same time needing, or certainly expecting from New Zealanders, more money going into the healthcare system because of some of the challenges. So there's a real, I think, difficult balance there, where on one hand you need more money generally to try and balance the books, either through high revenue or not spending as much, but you also need to be spending more, apparently, on the healthcare system to increase those outcomes. That means that, again, you've sort of still got this tension there where even under these sort of policy settings, you still have a deficit for half a decade or so. It's still pretty unpalatable for a lot of New Zealanders. So a lot of difficult choices, I think, ahead, a lot of balancing to be done.
And lastly, does this latest policy, because I know that this is just a nugget of Labor, the Labor Party's fiscal policy that they'll obviously announce ahead of the next election, does this make you excited for it or a bit hesitant?
Oh, look, I don't know if economists ever get sort of too excited before we get details and similar. So look, we'll continue to wait and see and assess how that happens. And that's true sort of all political parties. All of this stuff is important. It makes a big difference to people's lives. It has big consequences for the government. So we do look at that and try and understand what it means. But look, so far, we always withhold judgment. And probably most importantly, as economists, we're looking at this from a policy perspective. Yes, there's politics involved, and certainly seems to be some sort of more personal politics involved all the time at the moment. But we're looking at it from a policy point of view. What does it mean for the country? What does it mean for the economy? What does it mean for people and society? So that's sort of how we're focused on it. And we'll take all the information that continues to come through and try and understand what that means, and hopefully add a little bit more context to what is a usually quite politically charged conversation. We want to make sure as economists that we're bringing a little bit more of the sort of underlying facts and thinking to it.
Well, the fact of the matter is this just hasn't lit the world on fire.
No, and to be honest, maybe that's a good thing from a tax policy point of view, because, the way that tax policies go, they can either light the world on fire in a good way. I can't think of one that's really done that in recent times, or in various shades of people getting quite concerned about it. So potentially a slightly smaller one is a lot more politically expedient and more efficient, but certainly economically it feels like a little bit of a missed opportunity to have sort of more comprehensively laid out how to structure things in a better way. But as usual, politics probably will rule the day there.
Thanks for joining us, Brad.
Thank you.
That's it for this episode of The Front Page. You can read more about today's stories and extensive news coverage at nzherald.co.nz. The Front Page is produced by Jane Yee and Richard Martin, who is also our editor. I'm Chelsea Daniels. Subscribe to The Front Page on iHeartRadio or wherever you get your podcasts, and tune in tomorrow for another look behind the headlines.